Action Jackson, rocking and rolling. What is cooking? Good looking. It's good to see you. We're going to get into some asset acquisition, some tax savings, everything in between. I'm going to walk you through a couple of things we've been thinking about, talking about, teaching about, and buying about. I'm going to show you all this stuff. The name of the game, in case you just got here, is that we buy assets that produce profit. When your income from the assets that you acquire is greater than your monthly expenses, you are financially free and you never have to work again. That's what we talk about all the time. I'm going to walk you through some of the name of the game. If you're new here, my name is Will. Let's get into it. We buy assets. The assets need to produce passive income. Can y'all see my screen? Yeah? The assets need to produce passive income. So we are disconnecting our money from time. Most of the stuff that we do inside of our life requires our time to provide value. If I can disconnect my time from the value that I provide in the free enterprise system, in the great land of America, then that's called passive income. The time is not required for me to generate income. So I buy assets that produce passive income. The passive income, when it's greater than or equal to my expenses, I'm financially free. So let's put some colors on this. I buy assets. Those assets produce passive income. When the passive income is greater than or equal to my monthly expenses, I'm done working. This is retirement planning 101. This is not rocket surgery. This is very simple, very basic stuff. That's the focus. Now, one of the things that can happen here is you get so complicated so quick in the financial world. Finances gets complicated. The next thing you know, you're talking about derivatives or puts and calls and option trading or all kinds of crazy stuff. If you want to retire, it's very simple. You buy assets. You have something that provides value, that generates income, that doesn't require your time. That's the core element of retirement planning 101. You have assets that produce income that don't require you. So we're going to get deeper into this. I'm going to walk you through a couple of different things, some conversations that I had lately. I've got a client of mine that I'm working with right now acquiring an asset. It's going to generate him a lot of tax savings. I'm going to walk you through some of that. If we get time, I'll get into opportunity zone investing, how you can take a capital gain from a stock, from a crypto, from a business that you sell, and you can roll that capital gain into opportunity zone investing. Then you can defer a tax bill, number one. And number two, if you hold that real estate long-term, that real estate that you buy, if you hold it for 10 years or longer, that becomes tax-free. We'll talk about that. The core element, though, never changes. We always start with that, and we're going to get deeper into other stuff. We buy assets that produce profit. So if I go out there and I buy, let's say, a 2-unit complex. I got door 1, door 2. I buy a duplex. And that duplex is generating me, let's say, $1,000 a month. So it's giving me $1,000 a month in profit when I own this asset. If my personal living expenses are $5,000 a month, so let's put some colors to this because colors help us. My personal living expenses are $5,000 a month, and I've got an income of $1,000 a month. How many assets do I need until I'm financially free? So I've got a duplex. The duplex is giving me $1,000 a month in profit. It's giving me $1,000 a month. My expenses are $5,000 a month. How many assets do I need? The audience said in the chat, what did the audience say? How many assets do I need? 1, 2, buckle my shoe. I just need 5 assets, right? That's the game. That's what we play. So let's get into it. Let's go through a bunch of different things. And it's all interweaved, man. How you buy assets is how you save on taxes. How you save on taxes gives you more income to buy more assets. How you grow your income through marketing and sales and growing your business is how you get more customers, how you get more money in your assets, your ice machines, your Airbnbs, your rentals, whatever. It's all connected. The skills that you use to grow your business are the exact same skills that you use to acquire assets, the exact same skills that you do to lower your taxes. So let's get into that. I had a conversation today with a guy. We'll call him Mike. He has W-2 income. If you're an employee and you're watching this on whatever channel you're watching this on, I'm all over the place now. We're on like Twitch and Kick and YouTube and Facebook and Twitter. I think we're live on Twitter. It's all X. My bad. So we're everywhere. So wherever you're at, let me know in the comments. If you're an employee, type E in the comments. I think I can see your chat over here. If you're a business owner, type B. If you're a blend of both, if you're working a full-time job and you're starting your business on the side or whatever, just type both. B-E, both. Employee, type E. Well, I was talking to Mike. Mike earns income as a W-2. And let's say that Mike has $400,000 in income on his W-2 job. The conversation that Mike and I were talking about is that he wants to buy assets, number one. That's his objective. He wants to buy more assets. He's got one property now. He wants to buy more. And he wants to reduce his tax bill. He wants to lower his taxable income. So we're going to talk about doing both of those things. One of the things that you can do, excuse me, is you can go out there and you can buy a rental. And if I buy a rental, when I file my taxes, I'm going to file my taxes on what's called a Schedule E tax form. And I can deduct and pull some stuff off of that, but that's not going to go against my active income. That's my passive income. One of the strategies that he and I talked about is converting an asset. So it goes out there, we buy a rental property, we buy just a residential home, and we turn this into an Airbnb. So instead of being a long-term rental, this is going to be a short-term rental. And when it's a short-term rental, what happens now is you can do something called the short-term rental loophole, where if somebody stays there 7 days or less, and there's a checklist of things that you need to do, but you materially participate in the management, running, property management of this short-term rental property. And if you qualify and you do those things that the IRS requires you to do, and you check all those boxes, then yes, you can now qualify as a short-term rental loophole. And what that means is that all the losses, all the expense that you put into improving this asset, repairs, maintenance, property management costs, cleaning costs, all of those expenses can now become a deduction that you use against your ordinary income from your W-2 job. So let's say that he goes out there and he buys a, let's call it a $300,000 house. Now, we're gonna blend a couple of different things. We've got depreciation. We're going to accelerate that depreciation through the study of cost segregation. And then we're going to use bonus depreciation. So we're going to blend three different tax things all in one and try to lower this taxable income. So if he buys a $300,000 house, let's put some color on that so we can all know what we're looking at. $300,000 house. The general rule of thumb, don't take this to the bank, but the general rule of thumb is that between 20 and 30% of your purchase price is going to be what's depreciable. Of the amount that you can deduct off of your taxes, the depreciated amount. So if he buys a $300,000 house, 30% of that, ballparking, $90,000. Let's just go with a ballpark so we have a number here, but of course you need to do all the due diligence and stuff on that. So that $300,000 house, just from one line item, one tax savings, is going to hypothetically create a $90,000 deduction. So depreciation, just really quick, what does that mean? That's a big word. I don't know what it means. Depreciation is the IRS acknowledging that things break down. I've got a microphone right here. This microphone over time is going to break down and be less valuable. The TV behind me over time is going to be, that's not a real fireplace? No, that's a TV. Gotcha. Okay, no, okay. So it's going to become less valuable. The IRS has certain things that are inside of your home that depreciate in value. The carpet, the flooring, the electrical wire, the stuff inside of your house becomes less valuable. You know, like when you drive a car off a lot, like if you buy it brand new, it's worth less. It depreciated in value. Why is that? Because it went from new to used. If I have a used car, it wears down. The transmission grinds year after year after year. The engine, the pistons, the cylinders, everything's wearing down. So that's what depreciation means. It's the IRS's acknowledgement that things become less valuable over time. It's wearing out. They're going to give you a deduction on that. They're going to allow you to deduct that. So what we're going to do is, number one, we're going to calculate. This is like a cost segregation study. You have an engineering company, or some tax firms do this. We do this at my tax firm. Well, they'll come in and they'll estimate what the things you can deduct and depreciate from the things you cannot deduct and depreciate, and they'll give you the number. And then you can take that number to your CPA, to your accountant. We do all of this in-house, but you take it to your CPA and accountant, and then they take that number, and then you could do one of two things. You could accelerate that, or you could draw it out over time. So if we accelerate that deduction, in this guy's case, that $90,000, let's turn that into a red. That's going to be a subtraction. He didn't spend $90,000. Hear me on this. He didn't spend $90,000. He spent money on a down payment to buy his $300,000 house. Then he turned that $300,000 house into an Airbnb or short-term rental. That's what his goal is. Your goal may be different, but his goal was to buy the Airbnb and to do that, to make income through an Airbnb. Cool. So he buys a $300,000 house. Maybe he puts $30,000 down. Maybe he puts $60,000 down, something like that. You put your down payment down, depending on the finance type, and he buys the asset. Well, the asset's going to generate him a tax deduction. In just one tax strategy, one deduction, not all of them, just one line item of all the things that we can do on the asset side, it's going to generate hypothetically a $90,000 deduction through the understanding of depreciation, the cost segregation study, figuring out how much we can depreciate. And then recently, in the big, beautiful bill passed in the Trump administration, is the acceleration of all of that with 100% bonus depreciation being permanent as of now. So that $90,000, because of the short-term rental loophole, can be accelerated all into 1 year because of the big, beautiful bill, and he can lower his ordinary income. So this $90,000 is going to show up over here as a subtraction. His W-2 full-time income was $400,000 minus $90,000. That means that his taxable income is now what? What's 400 minus 90? Let me know in the chat wherever you're watching this at. I'm no rocket surgeon. I'm no math magician, but I do know that 400 minus 90 might be 310,000. So that one line item, not all the line items, just one, brought down his taxable income from 400,000 to 310,000. So instead of being taxed on $400,000, let's say, let's just go easy math. 25% tax bill on $400,000 is $100,000. So he would have owed Uncle Sam 100 grand. Let's color that red for ugh. That's what that sound effects is. Ugh. So instead, now he's only going to be taxed on 310,000. What's 25% of 310? I don't know. Hold on. Let me get my calculator. Handy dandy calculator order. Shout out to my teachers who said I would never have a calculator growing up. You can't just walk around with that in your pocket all the time. Oh. So your tax bill is now going to be $77,500. That's your new tax bill. What's the difference between that and $100,000? This one strategy saved him $22,500 in taxes. Let's color that in green because green means profit. Just by doing this one thing, this guy was making, as of right now, July 2025, W-2 income, $400,000. This is his W-2 income, $400,000. He wants to lower that. One of the strategies we talked about is going out there buying a property, turn it into a short-term rental using the short-term rental loophole. He can materially participate in that 100 hours, blah, 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 blah. All the stuff you have to do with the IRS. And then he can accelerate the depreciation, use bonus depreciation all in 1 year, accelerate that. That's going to save him $22,000 in taxes for 2025. The time value of money states that money in your pocket today is more valuable than money in your pocket tomorrow. Therefore, he's going to have $22,500 in taxes that he doesn't have to pay anymore legally, that he can do whatever he wants with. Now he's got $22,500 that he would have sent to the IRS. He now gets to keep. What does he want to do with that? What do you recommend he does with that money? Let me know in the comments. In the chat, wherever you're at, let me know. I think I can see the chat over here. Let me know. What would you do with $22,500? Renee, Five Guys Miller, let's go. Oh my gosh, 310. What's up? Renee, I didn't even know you were here. I just saw the chat pop up. Renee, Five Guys Miller, shouldn't you be working? Oh my gosh. Oh my gosh. Look, I can add it to the broadcast. Hold on, what does this do? Oh my gosh. I don't know if Renee's here anymore. She might have dipped like a chip. But $22,500. What can we do with $22,500? Let's find out. Let me see if I can get rid of this guy. See if I can pull this up on the screen. Check this out. Let's go here. Let's pull this up. Let's go to the internet machine and let's find some stuff that we can do. So one of my favorite things, I just got back from Buena Vista, Colorado, and they don't call it Buena Vista. They like Buna. I don't know the story behind that, but they don't speak Spanish up there, apparently, because it's Buena Vista. But anyway, it doesn't matter. So I was in Buena Vista, Colorado, and I was looking at some Opportunity Zone properties up there. This is where I was located. Here's Buena Vista. Can you see that? Boom. That's me. So that big purple zone, you see that big purple zone? Purple people leaders? The big purple zone is Opportunity Zone. So according to the IRS, Congress passed these laws that says all of these purple zones all around the United States are places that I'm out of work, sir. All right. Yo, chill. Dang. Chill. Going to pick up my baby daddies. 1, 2, 3. She's got 3 baby daddies. No. She's got 5. 5 baby daddies. How many kids? 5. 1-to-1 ratio on baby daddy to baby. And then she moves on. She's done with you. Anyway, so the Congress passed these laws where you can take your money and you can invest in these opportunity zones. There's California. There's Arizona. We move east to New Mexico, passing through Texas, into Louisiana. What's after Louisiana? Mississippi. Then we get into Alabama, Georgia, and Florida. Going up to South Carolina, North Carolina. gets foggy in here. This is like Virginia and West Virginia. Then we kind of get into like Maryland. I don't know. Vermont is somewhere out there. But anyway, the point is, check this out. So I was in Buena Vista, Colorado, and I was looking at some property in this purple zone. Really cool stuff you can do inside of an opportunity zone. Number one, you can take a capital gain. So let's say our man Mike, we were on the phone with Mike earlier. Let's say that Mike, hypothetically, let's draw a line. Hypothetically, let's say Mike has a $200,000 capital gain. For whatever reason, Mike was investing and he made $200,000. That's awesome, dude. Maybe he had some NFTs, psych. Maybe he had some stocks, crypto, whatever. He had a capital gain and he made $200,000. Uncle Sam's looking at him sideways and he wants to tax that. At just a 20% capital gain tax rate, 20% times $200,000 is $80,000. Is that right? I think we're right. Let's go with it. $80,000 is his tax bill. We're going to color this red, which is the color of ouch. $80,000 is his tax bill. Mike calls me and goes, oh, man, we got to do something about this. So if Mike's got a $200,000 capital gain, one of the first things that you can do inside of an opportunity zone is you can take a capital gain from something else, from a crypto transaction, from a business that you sell, from a stock, from whatever. He made $200,000 doing something. He takes that $200,000 capital gain and he moves it and rolls it into an opportunity zone. Number one, that's going to defer the payment of that bill. So he still owes the $80,000 tax bill. You can't get rid of that capital gain tax. That is still due. However, you do buy yourself time. So level number one of this strategy is a deferral strategy. He's got $80,000 that is owed. However, if he puts it inside of an opportunity zone, that's going to buy him time to deferral. Strategy number two, and this is really where it's supposed to be. This is the meat and potatoes of the whole thing. That is just icing on the cake or icing on your meat or potatoes. Who puts meat on their potatoes? Icing on their meat. It doesn't matter. So the real thing here is that if I buy in an opportunity zone, which is why I was in Buena Vista, Colorado, if I buy inside of an opportunity zone and I hold it and I hold it, and I hold it. When they say hold your horses, this is what they're talking about. So if I buy a property, real estate, inside of an opportunity zone, and that property value goes up over time. This is time. This is an arrow. You need to use your imagination to understand some of this stuff. So let's say this is year zero. And I buy it. And then day one, and then day two, and then month one, and then year one, and then year two. And time is going by. Tick, 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 tick. Now, and I hold this thing, let's say, to year 10. If I buy real estate inside of an opportunity zone and I hold it for 10 years or longer, that entire capital gain of that property is tax-free. So if I buy a property, what Mike is doing, if we're looking at $200,000 in capital gain and $80,000 tax bill, and we want to do something about this, if he buys, and let's say he buys a $100,000 property inside of an opportunity zone. So we go to the opportunity zone map. We do this in the right way. There's an entire process to doing this. We go to Buena Vista, Colorado, hypothetically, and we go, ooh, there's a nice ranch we want to buy. There's a nice commercial property we want to buy, whatever. So he buys that property. $100,000 is the value of that property. We hold it for 10 years. It goes up in value to hypothetically $900,000 is the new value. He holds it for 10 years or longer. That is an $800,000 gain on that real estate property, which he does not have to pay tax. There is no tax on that $800,000 because it's inside of an opportunity zone and he purchased the property the right way inside of an opportunity zone. So how much money would he save? Well, at a 20% tax rate, because he set this up right in the beginning, 20% times $800,000 is $160,000. $160,000. Do we have any math majors or math nerds to double check our math? Let's go. What's up, Anthony? Good to see you, brother. Good to see you. I see you in the chat. $160,000 is going to be his tax savings. So that's what I'm talking about. Huh? He does not have to pay capital gains on that $800,000 in profit. Capital gains tax rate, 20% times $800,000, means that he does not pay tax on that. That's $160,000 in tax savings. Baby, that's what I'm talking about. All because you pre-planned. All because you thought about it ahead of time. This is the type of stuff that your tax planner should be talking to you about. And if your tax planner is not talking to you about that stuff, you might want to find a new one. you might want to find a new one. If you want to talk to my team, I don't know if we have any availability, but you can always book a free call, moneymanmyers.com. moneymanmyers.com. We might have some free stuff. I got free questions, free tools. Just go save your spot to book a free tax savings call to estimate tax savings together. I'll send you all kinds of free spreadsheets, free calculators. I've got a tax savings calculator. You can kind of estimate how much you're overpaying, all that good stuff. But let's see if we can find one more thing. What is the thing called? IRS. Oh my gosh, I might have to come back to this. Yeah, let me search it later. I'll look for it later on. I'll try to find this for you guys. But anyway, I just wanted to test this stuff out. I wanted to share with you some of the stuff that we're doing to help save this guy on taxes, how he's buying assets, acquiring assets, how we got rid of an $80,000 tax bill, saved 106, all the stuff that we covered today. So if you're new here, it's nice to meet you. My name is Will. I go live all the time, and I teach you what I did to get financially free at 29. I've got a free class I'm teaching this Saturday. If you want to register, the class is free. Just go to moneymanmyers.com or whatever platform you're watching this on. I stream everywhere. Whatever platform you're watching this on, go look for my link in my bio, my website. It's all on my website, moneymanmyers.com. Go register. The class is free. If you want to learn how to find assets that produce profit and then practice buying them in a virtual reality world, like put on your VR goggles or like a video game. So if you make a mistake, you just reset the video game. That's what I'm teaching how to do it this Saturday. So to go register, it's free. And then I think we'll get out of here. I think we'll dip like a chip. Yeah? Renee, 5 guys Miller, she's out. Anthony, she's out. He's out. We're going. We're going. All right, guys, I'm going to catch you on the flip-flop lollipop, give the dog a bone. We covered a lot of ground today. We'll cover more later. Peace.